Welcome back, viewers at home. Tonight we are tackling the most uncomfortable but a reality called debt. Now, there's something I just want to read real quick, which Debt Counselors Association of South Africa really took out to say the personal debt has surged past 2.5 trillion rands, while households' debt to income ratio hovers around 65%, with some households allocating as much as 75 to 80% of their income towards repaying loans. This is some of the realities of, or lived realities of South Africans, and you can only imagine what it means for those who can't even afford a loan but get a credit card to sort of, fund the groceries and things that they need on a day-to-day basis. But for more insight, I'm delighted to say I am joined by an expert who's going to help us unpack some of these issues that we find ourselves dealing with when it comes to the conversation of debt. I am joined by Amira Asvat, who is a seasoned finance expert, lecturer, and a certified financial planner. With her expertise, we are here to understand personal finance, investment, as well as getting it right the first time. Assalamu alaikum. Jazakallah so much for joining us.
Walaikum salam. I think you know what, your whole introduction, you've literally just done my whole interview, so I can leave now.
No, we still need you, because right now I feel like a lot of times we look at debt from something that I owe versus, how do I build my credit score with something that I owe. There's so much. My research doesn't go that far, so I need you to be here to help us unpack some of these complexities. But Jazakallah so much for joining us. I want to find out from you. Let's take it from the basics to say, what is debt? The types of debts that are there, and the impact of an unmanaged debt scenario.
Okay, so debt is something that you borrow from someone with the promise that you're going to pay it back.
Yeah.
All right, so there's two types of debt. There's secured debt, which is like your mortgage on your house, your car finance. So that's basically debt that's secured, meaning that there's something attached to it. So like if you take out a bond on your house, it's the house that will get taken back if you don't pay it. With car finance, it's your car that you're paying for. So if you don't pay for it, they're going to take the car back. Then you get unsecured debt. So things like your credit cards, your personal debt. I mean, if you're taking out credit on a credit card, what they're going to take back from it, because you're obviously using that money to buy a lot of different things. So they can't come and take all those things back. So yeah, so that's the two types of debt that we have.
And in South Africa, what would you say are the most common debts that we find ourselves taking or living off?
So credit card, number one, personal loans, also student loans. There's a lot of students out there who don't have access to funds. There are companies that give out bursaries, and obviously there's NSFAS, but not all students can get it, because there's obviously such an influx of students that want that kind of money to go and study, but they obviously all can't get it. So there are private companies that do give out loans, that do give out student loans, or they give out bursaries. And then obviously there's a clause or contract in place to say that after your 3 years or 4 years of studying or whatever it is, you'll come and you'll work for us. So that's how they'll pay the bursary back. So a lot of companies do offer that. It obviously differs from company to company. So I would say that the credit card and obviously the personal loans. I mean, people are taking out credit cards to buy groceries, basically to live, which is not a good thing. And there's so obviously the personal loans, which is also there, and not only personal loans from like banks. There's also the personal loans from loan sharks, micro lenders that are giving you money, and that's not a great thing, because those institutions are charging a lot more than the regulated interest rate that they're supposed to be charging you.
Yeah, that is something, and that's something that, many viewers like myself sitting here, it's something that we really need to inform ourselves about. Because speaking of this conversation on high interest rate, you find that you get a loan and it says that you're going to be paying so much, and then until Mr. Khanyaho comes out to say, repo rate is at this, and then you're like, okay, I didn't sign up for this. Where do I go? What do I do? And that's where I want you to help us understand, because we know that so many people are struggling with high interest debt, like, as you mentioned, credit cards and that of personal loans. What are some strategies that you would recommend in tackling this debt that is, being strangling you by the use of this high interest rate?
So when it comes to interest rates, obviously it fluctuates. And like you're saying, with the repo rate, the interest rate keeps fluctuating. So yes, you might take out a loan at a certain interest rate, but then if the repo rates change, the interest rates are going to change, and then your payment changes. So unless you set up a fixed interest rate with your bank, that means that you're going to pay that amount of interest for the term of your loan, for however long it is, because you fixed it in. And I love to do these talks, and I love to be here because I get to say all these things that a lot of people don't know, and like some people might feel like, this is boring, we know this stuff, but there's so many people that don't.
Yeah.
I've been doing a lot of these workshops, in conjunction with the University of Johannesburg and our community engagement and with other stakeholders as well. We actually did a workshop last week with students where we had one of these credit companies come and speak to them also, and we were talking about the same thing. And so for like some students in the beginning, they were like, okay, but what debt do we have? And then we started talking about all these things, and it made sense to them, and they're like, okay, but now we know, like, we're going to start working next year or in 2 years time, so now we know when we start working what to look out for. So just coming back to the interest rates, you need to look at the institution that you're taking out your loan from. So whether it's a credit card or whether it's a personal loan or whatever it is, whether it's your car finance, look at the interest rate. If you can get a fixed interest rate, that means it's going to be fixed, it's not going to change, and that's the amount that you are going to be paying for your term. So obviously it makes budgeting a lot easier because I'm going to be paying that amount. There's a lot of people who live paycheck to paycheck. And if your interest rate is going to go up, how are you going to afford that increased amount, on a monthly basis? Because you've now worked it in. So coming back, the first thing to do is to budget. I always come back to budgeting, and now you can see why it's so important. It literally comes into every aspect of financial planning. So you need to look at your budget first. You need to see what is your income that you're getting, or all of your income. You might be getting a salary. You might have a little tuck shop on the side that you're getting money from. You might have a place that you're renting out that you're getting rental income from. So take all of your income and add it all together. Take all of your expenses and add it all together and minus the two from each other and see how much do you have left. Whatever you've got left, can you take some of that money and can you put it into paying off some of your debt? Because that's the first thing that you should always do. If for some reason you come into inheritance money or just some money somewhere along the line,
Bonus, maybe.
maybe you'll get lucky. Take that money and try and pay off your debt first, because if you pay off your debt, that means it's one less thing to worry about and you'll have more cash flow. So whatever you're paying, if you manage to pay off your credit card with the bonus that you get, remember, you're not going to pay that credit card anymore. So that's extra money that you're going to have that you can save. So one of the tips that we always give is, if you are now saving more, take that money and put it into something for your emergency fund. So when the time comes and you need your emergency fund money for an emergency that has happened, instead of going and taking out a personal loan or increasing your credit card limit, you don't have to do that and pay interest on it. You've now got your own money that you've saved. So use your emergency funds. So that's the tip that we always try and give people. Also, try and borrow from your friends or your family first, because they're not going to charge you interest before running to an institution, because they're obviously going to charge you interest. So try and try and borrow money from someone that you know before you go off and try and get a loan from the bank.
This is quite interesting. And the idea of emergency fund, I don't know. I'm sure there are so many like Maimunas who put it there, and every day there's some emergency. But alhamdulillah, some banks, they have you put a notice for 30 days or 7 days, where now you have to go to the bank to access those emergency funds at that. And I think with that being said, and I love how you just highlighted some of the tips around, prioritizing paying off the debt and budgeting in that sense. I want to find out from you, what are some common mistakes people make when trying to pay off a debt? Because I know for most university students, they go to these retail stores and they buy something and they get to pay it over 12 months and they realize that the balance is not going down.
Yeah.
So I want to find out from you, what are some of the common mistakes that we make with credit and personal loans that in terms of paying it back?
So I'm sure you also get enough of those calls where they call you and they're like, oh, we want to offer you a credit card, or we want to increase your credit card limit, or, I mean, everyone's getting those calls. So it's so easy for you to just say yes. But people don't realize that you have to pay it back and you have to pay the interest on it back. So that's one common mistake. So people think they're just giving it to you for free. They're not. You have to pay for it and you have to pay it back. Another thing is, it's easy to go and to get a loan or to get a credit card or to increase your limit. So people find it very easy to go and take out that stuff because now, okay, it's easy for me to just increase my credit limit and then I can go and I can buy whatever it is that I want to buy. Also, I think it's impatience. If I look at students, for example, right, all my friends are buying the latest iPhone, so I have to have the latest iPhone, or all my friends have a certain type of sneaker, and I have to have it also. So I go and I open a store account, and I buy the sneaker, and now I pay it off over so long. But in that time, now I'm paying it off, but now I want that T-shirt, and I want something else. So you keep buying things, so you keep having to pay back, and the monthly amount increases over time because you're buying more. And that's something that we don't think about, especially as a student or as a young person who's just started a job. And this brings me to my next point of there's good credit and there's bad credit. And yes, having a credit score is amazing, especially if you're starting off at a young age. So like you're a student and you open a store account, or you are you just started your first job and you open a store account, so that you can start building up your credit. Because one day when you do want to buy the house or you do want to buy the car, you would have already gotten your credit score. So, a credit score is just basically to show you how quickly do you pay back credit. And the higher your score is, the better chance that you'll have of getting credit. So yeah, so that's why students and young people are encouraged to take out, whether it's just one of these retail clothing accounts. Like the workshop that we had last week, one of the presenters said that when he was a student, he got, I don't know if it was Truett's or Markham's or one of them, called and they were like, oh, we want to offer you a store account. And he was so thrilled and he was like, oh, they want to just give me all this money. And, and then somebody had to explain to him how it works. And, and it's basically to build up your credit score. And then he said he did. He opened the store account and he just, I think he bought a pair of sneakers. And what he did was when he got paid the next month, he went and he paid it. So his credit score he didn't have a credit score because he didn't have credit. He went and he paid it back. And then somebody explained to him, no, you have to just make little payments every month to build up your credit score. So yeah, so it's not about just opening the account and then paying it back as quickly as you can. That's not going to build up your credit. It's to see how you manage to pay it back over time.
Now, Amira, I want to circle back to something that you said in terms of fixed interest. Get your bank to set a fixed interest on that loan that you're taking. I want to find out, you have a loan ongoing. Is it possible to still get the fixed interest, or is it a matter of as you are getting the loan, that's where you need to request for that?
So it's when you take out the loan that you'll have to request the fixed interest. I mean, you can always find out from them at a later stage, but I highly doubt it because they would have priced it in, at whatever the interest rate was at that point. So that's why it's at inception where you say, okay, can I have a fixed interest rate so that you know you're going to be paying X amount over 5 years, for example, or whatever the term is. So that's it. Another thing also, just to come back, is shop around first. Before you decide you are taking out that loan or you're taking out that credit card, shop around and first see where can you get the lowest interest rate. And even if you've already taken out a loan somewhere and you still shop around and you see, can I get it at a lower interest rate? You can always try and move. So, because you always want to be where you're paying the lowest interest, right? I mean, we don't want to be paying off interest forever. So shop around first and try and see where can you get a lower interest rate.
And certainly this is just for informative purposes. We are not encouraging anyone to go there and take a loan and be in credits and be, in the conversations of interest and so forth. This is just to inform, because this is the reality of South Africa, the country
Yes.
in which we live in, where
Yeah.
you get people who, not everybody is with a Sharia bank, and currently it's like they are faced with whatever they are faced with. And I just want to find out from you, you said something that is quite interesting, because when we hear debt, headache, we're thinking my money, debit orders, all the other things. But now you said there's a good debt. And can you please dissect that for us? How does a debt become good for a person?
Okay, so thank you for pointing that out. And just to reiterate what you said, this is by no means financial advice at all. This is, purely a discussion that we're having. And if anybody is listening to this and they feel like it's triggering something in them, I'm advising them to please go and speak to their financial advisors, bankers, etc. This is not me giving advice, so just a disclaimer there. So good debt. What is good debt?
Yeah.
So good debt is like going now and taking out a retail clothing account so that you can start building up your credit score. Because you're doing it for a purpose.
Yeah.
So if you're taking out if you're taking out a mortgage on your house, it's good debt because you're buying a house, you're going to live in it.
Yeah.
But so bad debt is now you buying the car because all your friends have that car and you just have to have that car and you can't have any other car. So that's bad debt. It's when you're doing it for the wrong reasons. Good debt is you're doing it for the right reasons. Like, I'm buying a house because I need somewhere to live. I'm buying the car because I need to get to work, which is an hour away. So I have to drive there. So it's all about, why are you doing it? Am I buying that sneaker because all my friends have it, or am I buying it because the one that I had before that is broken and tattered and I can't wear it anymore? So that's where you need to decide good debt and bad debt.
Nice.
Yeah.
I'm loving that, because FOMO is not part of a purpose. FOMO is
No, not
something
at
you
all.
need to, the idea of missing out on things, you need to really work on yourself as a person.
Yeah.
And this brings me back to us clearing up some of the myths and the misconceptions around all things credit scores, all things debt, that you would like to share with myself, most importantly, and the viewers at home.
So when it comes to a credit score, I mean, you would need to have a credit score if at some point you think that you are going to need debt. And by that I mean, if you want to, if your long-term vision, do you want to buy a house? Do you want to buy a car? Because I mean, look, in today's day and age, and in the economy that we are currently living in, there's very few people who can actually go and buy a house for cash. So majority of people have to take out some or other finance somewhere in order to buy a house or to buy a car, or those big things.
Yeah.
It's not for you to go and take out a credit card so that you can buy groceries. If that's what's happening, then that is a huge problem. Please speak to a financial advisor and try and see how you can cut your costs. And again, it comes back to budgeting. So remember, a long time ago we spoke about budgeting, and I said to you that you start with your most important expenses and then you go down to your least important. So when you need to cut down, you start from the bottom and you work your way up. So I know your G-Wagon savings is somewhere on the top, and I don't want to cut into that for you.
You don't want to ask the balance at the moment.
Yeah, should we go there?
No, not today.
So you start cutting from the bottom going up. Cut out your unnecessary expenses. So it comes back to your budgeting and it comes back to your cash flow. What are you spending your money on? How much of your money is actually going into debt? How much of it can you save? Can you get a lower interest rate somewhere so that you can save more, so that you can build up your emergency fund? Or can you take some of that money? Can you pay it off into your debt so that you have less debt to pay? So look at your expenses, number one, and try and see where you can cut down on your debt. We are living in those times where it is very, very hard financially for a lot of people, and it's a reality. The economy that we're living in, look at our high unemployment rate. So all of those factors lead into all of this. That's why South Africans are drowning in debt. And we need to try and find ways just to try and reduce that debt. So number one is to try and cut down on your expenses. Number two is shop around and see where can you get a lower interest rate. And that will also come with your credit score, because the lower your credit score is, the higher interest rate you're going to be charged, because you are now seen as a high risk person. Like, oh, this person has got such a low credit score, that means they don't pay well. So they're going to give you the money very hesitantly, but they're going to give you a very high interest rate because you're going to have to pay it back. So try and look at your credit score, and that works with how well you are managing your debt and how quickly you are paying it off. Yeah, that's with credit score. And then also, if I can just say that when it comes to taking out a loan, credit, whatever, you need to look and see if the institution is recognized by the NCR. So the NCR is the National Credit Regulator, and you'll see it wherever you go, even in like your Radio Fashini, your Edgar's, they all have that certificate, the NCR certificate, to say that they are a registered credit provider. If they don't have the NCR number, please don't go with them, because that means they're not registered. So, and it's easy to check. So you can go onto their website. I think it's www.ncr.org.za. I stand to be corrected. Or you can call them. And what you'll do is you'll basically log into their website, and you'll put in the name of the place, or you put in the NCR number, and it should pop up. If they pop up in all the details, they're a legitimate company, they are registered, and they are authorized. If it doesn't come up, they are not registered and they are not authorized, and that means they can literally charge you any interest rate that they feel like. So if they're not registered with NCR, you can go to them and say, okay, I want to borrow 10,000 Rand, and they'll be like, yeah, sure, use your 10,000 Rand, and we're charging you a 50% interest rate, and we want our money next week. Because that's what happens, and it's reality, and we've heard these stories, and it is very, very scary, where people are paying 50% and up on microloans. So, there's people, I mean, we had somebody told us about 2 weeks ago at a workshop that we did that she borrowed 10,000 Rand, and when they came to fetch the money, she had to pay them back something like, it was over 50%, and they wanted the money like within 10 days. It was insane, and those stories do happen. It's not just made up stuff. So it is very scary. So if you are going to, if you are in desperate times and you are thinking of, oh, where do I get money from, please just make sure that it's from a registered credit provider.
Amira, we've checked the dead pulse, and it's beating, it's thumping, it's concerning. And I just want us to close it on a very light note. If you could just give us your personal mantra that, keeps you going in terms of, or rather helps you in your personal journey with finance and money.
So my personal philosophy is, if I don't have cash, then I won't buy it. So because I always feel like, am I going to be able to pay it back? So yeah, it's something that I'm a little bit scared of, like I'm saying, I mean, we've had the conversation now, yes, debt is good and debt is bad. So for certain instances, yes, I mean, like if you have a clothing account, that's fine. Just make sure that you pay it off. Or if you have a credit card, make sure that you're paying it constantly, but like I don't go and like pay it all off and then go and like take it all away and then pay it all off and then increase my credit amount, and because I just feel like I don't know if I'm going to be able to pay it back. So that's my personal view on it, but I mean, everybody is different. But in closing, if I can just say that, number one, check your expenses. Number two, try and set up an emergency fund. And number three, just go and check what interest rate you are paying, because you don't want to be paying higher interest rates than if you can get it lower, then you obviously want to pay the lower interest rate compared to the higher one.
Amira, you know what? You've made the conversation around debt manageable, something that we can talk about in our social settings, to say, oh, you thinking of taking a loan, here are some of the things you need to, look out for. And us advising each other makes us be more, aware and best know what is important, what is not important when considering to take a loan. But Jazakallah so much for coming in without fail and really giving us a very lighted note to all things money, because we know when it comes to money, nobody likes having that conversation. But Jazakallah so much for joining us.
No, Jazakallah for having me, and I'm glad that you can have these conversations, because that's what it's about. We should be able to talk about these things. Whether it's debt or whether it's wills or whether it's estates, whatever it is, we should be able to speak about it, with our friends, with our family. And like you're saying, I mean, now that you know, and if one of your friends come and ask you, you can say, this. And that's what it's about. It's about empowering each other. It's about educating each other and just letting people know, becoming financially literate about these things, because there are so many people that don't know.
Jazakallah once again, Amira.
Jazakallah.
Viewers at home, that was Amira Asvat, a finance expert, lecturer, and a certified financial planner, who was telling us that debt is not that monster you think it is. It's the monster you create when you take loans without information or when you take loans because of FOMO. So let us be more demure in our escapades of taking loans and be more productive and really prioritizing our needs from once seriously. But I hope you guys did enjoy that conversation. Now, if you have more questions, make sure you do slide into our DMs and hopefully we will forward them to Amira Asvat for more solutions. But for now, let's head over to an ad break. We'll see you just after this.